Debt is a concept that has permeated human society for centuries. It is often viewed as a necessary evil, a tool for achieving goals that would otherwise be unattainable. From buying a home to funding education, debt can open doors to opportunities. However, the relationship between individuals and financial institutions is complex. Banks and lenders have a vested interest in keeping consumers in debt, and understanding this dynamic is crucial for anyone looking to navigate their financial future. This exploration delves into the reasons why banks prefer customers to remain in debt and the implications of this reality on personal finance. At the core of banking lies a simple truth. Banks are businesses that profit from lending money. When a bank lends money, it does not simply give away cash, it expects to be repaid with interest. This interest is the bank's primary source of revenue. The more debt a consumer carries, the more interest they will pay over time. This creates a cycle where borrowers find themselves repaying not just the principal amount borrowed, but also a significant amount in interest. For banks, this model is incredibly lucrative. By encouraging consumers to take on more debt, banks can ensure a steady stream of income, which is essential for their ongoing operations and profitability. The banking industry employs sophisticated marketing strategies designed to entice consumers into taking on debt. Advertisements often highlight the benefits of using credit cards, personal loans, or home equity lines of credit. These promotions create a perception that debt is not only manageable, but also beneficial. Consumers are often led to believe that taking on debt is a pathway to a better lifestyle, filled with immediate gratification and convenience. This marketing approach capitalizes on the human tendency to prioritize short-term desires over long-term financial health. As a result, many individuals find themselves in a cycle of borrowing, where they rely on credit to maintain their lifestyle, further entrenching them in debt. The psychological implications of debt cannot be overlooked. Many individuals experience a sense of accomplishment when they make a large purchase or invest in an asset, often facilitated by borrowing. This feeling can be intoxicating, leading to a mindset where debt is perceived as a normal part of life. Additionally, the fear of missing out can drive consumers to take on debt for experiences or possessions that they believe will enhance their lives. This emotional connection to debt can make it challenging for individuals to recognize the long-term consequences of their financial decisions. Banks understand this psychology and often exploit it to encourage consumers to take on more debt, reinforcing a cycle that benefits the financial institution. Credit scores play a significant role in the relationship between consumers and banks. These scores, which reflect an individual's creditworthiness, are heavily influenced by the amount of debt a person carries. A higher credit utilization ratio, which is the amount of credit used compared to the total available credit, can negatively impact a credit score. This creates a paradox where individuals are encouraged to take on debt to build their credit history, but doing so can also harm their credit score if they exceed certain thresholds. Banks benefit from this system, as they can charge higher interest rates to those with lower credit scores, effectively punishing consumers for their debt levels while simultaneously encouraging them to borrow more. Student loans represent a significant portion of consumer debt in many countries, particularly in the United States. The rising cost of education has led many students to rely on loans to finance their degrees. While education is often viewed as an investment in one's future, the burden of student debt can have long-lasting effects on individuals' financial stability. Many graduates find themselves struggling to make monthly payments, leading to a delay in major life milestones such as purchasing a home or starting a family. Banks and lending institutions profit from this situation as they collect interest on these loans for years, if not decades. The cycle of student debt is a prime example of how financial institutions benefit from keeping consumers in a state of indebtedness. The consequences of remaining in debt can be severe, impacting not only an individual's financial health, but also their overall well-being. High levels of debt can lead to stress, anxiety, and a sense of helplessness. Many individuals find themselves trapped in a cycle of minimum payments, unable to make significant progress toward paying off their loans. This can create a feeling of being overwhelmed as financial obligations overshadow other areas of life. Furthermore, the long-term financial implications of debt can hinder individuals from building wealth, saving for retirement, or achieving financial independence. Banks, while profiting from this cycle, often do not consider the emotional and psychological toll that debt can take on consumers. As awareness of the pitfalls of debt grows, many individuals are seeking alternatives to traditional banking. Credit unions, peer-to-peer lending platforms, and community-based financial institutions offer different models that prioritize consumer welfare over profit. These alternatives often provide lower interest rates, more favorable terms, and a focus on financial education. By exploring these options, consumers can take control of their financial futures and break free from the cycle of debt that traditional banks perpetuate. Additionally, adopting a more mindful approach to spending and borrowing can empower individuals to make informed decisions that align with their long-term financial goals. Managing debt effectively requires a proactive approach and a commitment to financial literacy. One strategy is to create a budget that outlines income, expenses, and debt obligations. By tracking spending and identifying areas for reduction, individuals can allocate more funds toward debt repayment. Another effective method is the snowball or avalanche approach to debt repayment. The snowball method involves paying off the smallest debts first, providing a psychological boost as debts are eliminated. The avalanche method focuses on paying off debts with the highest interest rates first, ultimately saving money in interest payments over time. Both strategies can help individuals regain control over their finances and work toward a debt-free future. Understanding why banks want consumers to remain in debt is essential for making informed financial decisions. By recognizing the motivations behind lending practices and the psychological factors at play, individuals can take steps to break free from the cycle of debt. It is crucial to prioritize financial education, explore alternative banking options, and implement effective debt management strategies. Empowering oneself with knowledge and resources can lead to a healthier financial future, free from the constraints of excessive debt. Taking action today can pave the way for a more secure and prosperous tomorrow, allowing individuals to achieve their financial goals without being tethered to the weight of debt. If you found this information helpful, be sure to like and subscribe for more insights and tips on managing your finances effectively.